All right, welcome back. What we're about to talk about here today may be the most important conversation that you see all day. We are breaking down the systematic, potentially multi-trillion-dollar fraud scheme being perpetrated, perhaps not explicitly, I'm almost certain not explicitly, but implicitly by the way the system is set up with our government and our banking system. The extent of it now finally coming to light, or it's beginning to, through allegations that banks have been using bad documents to kick millions of Americans out of their houses. This, in part, is a way to potentially cover up fraudulent loan agreements that put people in those houses in the first place. Well, it's kind of two frauds, right? Or two questionable or suspect arrangements. Stay with me here. Complicated, but I really think this is important and worth understanding. In the housing market, first we saw borrower fraud. Improper documentation allowed an unqualified borrower to get a mortgage on a house that they surely never should have been given. That, of course, went hand in hand with incentives on the lending side to accept that fraud, to perpetuate that fraud. The banks giving those home loans the A-OK because it's good for the fees. All of this would normally be revealed during a foreclosure process when documents like that must be reviewed before anyone could actually be kicked out of a house. I want you to think of it kind of like the tide washing out and revealing the truth about what lies underneath the given housing arrangement. But that hasn't been what's happening. Perhaps an aversion to reveal the borrower-lender fraud and the extent to which that may exist on a core level could be quite a threat to big bank profits and, for that matter, the current banking system. So instead, you end up with today's reports that J.P. Morgan Chase, GMAC, two of the country's biggest home lenders, were either careless or downright fraudulent, in speeding through foreclosure proceedings, leading to speculation in all quarters that they were doing this to avoid the original lending fraud be found out. Now, we do not know the overall fraud rate. It could be very small in some areas and big in others. It's probably highly inconsistent depending on the bank and the region. The industry does do tests on little pieces of the overall loan portfolios. Think of it like using a dipstick to check your oil. Some of those tests do show fraudulent rates as high as 80 or 90%, even 97% in the most extreme cases. We can only hope that that is, again, the most extreme example, but whatever it is, few have more at stake in how these accusations are resolved than our next guest. Bill Gross, founder of one of the largest investment firms in the world, PIMCO, more importantly, one of the biggest owners of home mortgages in the world. The simplest way to put it, Bill's the guy who owns your house in some ways, because when the government sells housing bonds, I just want to know if you're going to give me a free house bill. He's the one that owns them. How much of a mess in real life are we looking at with the documents reconciling both the borrowing agreements, the lending agreements, and the foreclosure process, Bill?
Well, Dylan, it's a difficult situation to interpret. I think you did a good job in the last few minutes of trying to explain it. Let me just add an additional analogy. You've got an originator in terms of a bank or a GMAC that originates the loan. They pass that loan on to an eventual holder such as PIMCO or Fannie Mae and Freddie Mac. And in between, which I think is an important analogy here, you have a referee called a servicer. Basically, the servicer is the referee on this football field that decides whether or not to call a penalty, whether or not that the home should be foreclosed on. And in many cases, these servicers are the same banks and originators that produce the loan in the first place. So therein lies a potential for some of the conflict and some of the problems that we're beginning to see in terms of the interpretation of the foreclosure law.
What are the implications of this type of development and broadly the relatively tepid nature of the rate of economic growth right now on both government policy and investment and basically the dynamic of our own economy as we are forced to reconcile trillions and trillions in various housing agreements and all the rest of it?
Well, the more foreclosures that take place, the lower and lower the neighborhood goes in terms of its valuation, and the potential for homeowners or ex-homeowners to prosper and to thrive like they have in the past sort of goes downhill. And so consumption is affected, local neighborhoods are affected, and housing prices are affected, and it's something that the government doesn't want to happen. happen. I would say that over the past year and a half to 2 years that they haven't really done a great job in terms of getting to the heart of the problem. If they're only now forcing GMAC and some of the banks to relook at an interpretation of contract law as it applies to foreclosures, and that's a little too late, so to speak, but better late than never.
If you were to look at something that could be either debated or changed today that could improve the path, if you were to agree that we are in a path-dependent environment where what we do today has a meaningful impact in what happens to us tomorrow, how would you approach that conversation right now?
My solution, and one that I proposed back in Washington about a month ago to Secretary Geithner and others at the Treasury, was to and is to allow Fannie Mae and Freddie Mac to permit their homeowners that are attached to mortgages to prepay those mortgages. Right now, law, so to speak, doesn't allow a homeowner with a 6 or 7% mortgage to prepay that mortgage if its home is underwater. My point is that the home is still the same house if it prepays its mortgage from 7% down to an existing rate of 4%. It allows homeowners to basically be relieved of high interest payments, and it basically keeps them in their homes as opposed to moving them out of the homes. That idea seems to have been rejected, but if you ever wanted something to jumpstart housing in terms of housing prices and to permit consumption to move higher and to bolster the economy, that would be my primary idea.
How much of the barrier to that is anything along those lines would force the largest banks, the 4 biggest banks, the servicing banks, to reconcile all sorts of valuations that they don't want to have to reconcile right now, basically putting them at risk?
Of course, and PIMCO owns some of these mortgages too. And the problem is that the market price is 104 or 105 cents on the dollar, and that if homeowners prepaid them, basically the resultant realization in terms of the price would be 100 cents on the dollar, so there'd be a 4 to 5 cent loss. These mortgages are held not just by the PIMCOs of the world, but they're held by Fannie and Freddie, and they're held, by the way, by the Federal Reserve, because they've bought $1.25 trillion of these over the past year and a half. So there's a lot of vested interest that wouldn't benefit if this idea took place, but my idea suggests that Main Street, as opposed to Wall Street, is now in line for some benefits, and this would be a great idea.
Yeah, okay, well, listen, I would love to follow up with that with you. Speaking of Wall Street and Main Street, lots of speculation over the past few weeks and conjecture about information between Wall Street and Main Street. Reuters yesterday, as you surely know, doing a story talking about the Federal Reserve sharing information not only with large bond investors like yourself, but large investors generally. I'll quote from their story. They say, by necessity, the Fed spends a considerable amount of time talking to investment managers, bank economists, and market strategists. But a Reuters investigation has found that the information flow sometimes goes both ways, as the Fed officials let their guard down with former colleagues and other close private sector contacts. Does PIMCO, or do you know that other major institutions have better information as to what the Federal Reserve is thinking or doing than anybody else?
Oh, Dylan, I sort of liken this to to Wall Street buzz as to Wall Street inside information. I mean, it's like going to a neighborhood cocktail party and asking what you've heard about the Johnsons. No one really knows what goes on inside their house, but a lot of people are willing to gossip about it, and I think that's basically the situation. It's almost entirely gossip. No one knows what goes on inside the hallowed halls of the Federal Reserve, but we'd like to think we do.
Speaking of the Federal Reserve, Nassim Taleb, author of The Black Swan and a fairly provocative author on our current financial structure, predicting recently in an interview that the Federal Reserve will be gone in 25 years.
Oh, I think there's always going to be need for a central bank to engineer, and yes, that's a nasty word these days in terms of maneuvering interest rates, but to serve as an intermediary between Wall Street and Main Street. The days before central banks were not good ones in terms of the tremendous volatility up and down in terms of yields and deflation and inflation, and we've certainly had a much calmer economy in the last 100 years or so since the Federal Reserve was created. We're going to have another 100 years as well. All
right, listen, wonderful to get some time with you on this, my latest and newest program. It's been a while since I've seen you, and I'm going to hit you up for that free house. So you get free houses in the card somewhere, right? No?
All right.
Thank you, Bill. Bill Gross, founder at PIMCO.